Japan's central bank is going to pump trillions of yen into the economy. It's an extreme stimulus program. They're going to increase their balance sheet by a third. Look over at the left-hand column here. It says central bank balance sheet assets as a percent of GDP. So the United States, we see here at 26%, and it was the biggest in our history. And look at Japan's central bank up there at 57%. So it's an extreme stimulus measure. It's similar to our Federal Reserve's quantitative easing program. Just this past week, the Federal Reserve stopped purchasing bonds in the open market. So it's the end of QE3. And the purpose of that program was to increase the demand for bonds. And when you do that, of course, the price of the bonds go up. And then when you do that, the bond yield goes down. And the purpose of the program was to make long-term interest rates go down for several reasons. One is it was supposed to stimulate investment, but also it was supposed to force people to get into equities. In other words, if you weren't making any money on your debt, you might as well go into equities. So it was a way to pump up the stock market. In any event, our Federal Reserve stopped doing that this week. It led to a historic high in the Dow Jones Industrial Average and also the S&P, and it caused the Japan stock index, the Nikkei, went up 5%. And as a result, so the yen weakened against the dollar to its lowest in 7 years. And the reason for that is that the relative interest rate differentials, it's expected that the Federal Reserve might start increasing rates in the summer of 2015. The Bank of Japan has just poured all this money and liquidity into the market, so their rates are going to be low. And so people would say to themselves, if I'm going to invest in a currency, I'd rather invest in the dollar because it has a higher interest rate attached to it. So the real problem that the Bank of Japan and the Prime Minister are dealing with is deflation. And deflation is a situation when the general price level is declining. So it's the opposite of inflation. Inflation is when the general price level is rising. The problem here is that if you think prices are going to go down, then you're going to curtail your spending in the present. And if everybody does that, what you have is a contracting economy. And Japan has been contracting basically for 2 decades. Lost decades. And the decision made by the Bank of Japan was a 5-4 decision, so I don't think that's happened in their history, so it's something of a gamble. And their purpose for doing it was similar to our Federal Reserve's. They're forcing bond yields down. That's going to force the stocks up because people are getting no returns on bonds, so they're going to seek better returns. It's the same thing Mario Draghi has talked about. He's the head of the European Central Bank, and last year his phrase was, "I'll do whatever it takes," and that was thought to do something to the equivalent of a quantitative easing, and so it reassured markets, and he ended up not having to do much of anything. He's constrained by Germany because of their past experience with hyperinflation, so that's a geopolitical thing that remains to be seen. So we have a weak Japanese currency. The yen is weak. From 2012 to now, the dollar has increased by 46%. So remember that if we say the yen is weak, that's the same thing as saying the dollar is strong. They're just reciprocals of one another. And remember that a weak yen means that Japanese exports will increase, and a strong dollar means that American exports will decrease. For example, if you're the Japanese person wanting to buy an Apple product, it's now going to take more yen to buy the iPhone. And the law of demand comes into play. If the price of something goes up, you buy less of it. So it will be a strong dollar will be good for American importers, but will be difficult for American exporters. If you look at the Dow Jones Industrial Average from its bottom in March of 2009 to now, it's gone up 166%. Just this month, I sent out an earlier posting talking about the volatility, and I think the Dow had gone down over 5%, but for the whole month now, because of what happened in the last few days. The Dow is actually up 2% for the month. And if you look at the U.S. around the world compared to around the world, you've got to say that we're in the bright spot. We have 3.5% growth for GDP in this last quarter. We've got unemployment at 5.9%. So you look around the world and you say, well, China's growth is slowing. And China also has a massive misallocation of resources in the real estate market. I mean, you've probably seen the programs on 60 Minutes where they talk about whole cities and whole malls that have new buildings and no tenants and no people. So that will come to bite them. Europe is in a near deflationary situation, similar to what Japan has been in for 2 decades. And you add to that the geopolitical problems with Russia in the European markets. And it's hard to be very optimistic about the future growth of the world economy. And the developing economies are dependent on the rich countries for growth. And so if the rich countries aren't growing, it's difficult. The United States used to be able to be the locomotive that could pull the rest of the world behind us, but we're no longer able to do that because of our indebtedness. I hope some of this is beginning to make sense. As I've said before, I think it's like learning a foreign language, and your ears sort of get tuned into a couple of words here and there. So if you don't understand anything, that's okay, and if you understand a little bit, that's great. Bye.